Hey, Doug Smith with First Pacific Mortgage. Wanted to take a couple minutes today and do a little bit of a deeper dive into mortgage interest rates, what does drive them and what actually doesn't drive them. There's a lot of misconception out there about the influence that the Fed has on mortgage rates in particular. Wanted to speak to that and what are the market forces that actually do come into play as mortgage rates find their level. First and foremost, the Fed does not directly control mortgage interest rates. The rate that the Fed has influence over is the rate that banks pay to have cash on hand overnight. So it's the borrowing rate for overnight money. Think of it as what banks pay to have cash on hand. The only rate that gets directly influenced when the Fed makes a move is the prime rate. So when the Fed cuts rates, you will see credit card rates go down by the same amount, home equity rates go down, and some commercial credit. What the Fed policy and rate decisions do come into play as a factor on is the impact that the financial markets see these Fed policy decisions having on the economy and financial markets as a whole. The Fed's objective is always to help support and guide the economy towards having healthy economic growth without too much inflation. The market's going to do its thing, but the Fed can hopefully provide some guidance and border collie the economy and the financial markets, as it were. What really does drive mortgage interest rates is forward-looking estimates about inflation is a big factor. Inflation is, broadest sense, the change in what we pay for goods and services. If inflation is anticipated as going up, any investment is going to need to outperform inflation to wind up yielding any money in real terms. So if inflation is expected to go up, mortgage interest rates will go up to kind of bake that inflation expectation into the cake, as it were. Then the other piece that it looks at is forward-looking estimates on economic activity. If the economy is seen as growing on a healthy level, then it's anticipated that there's going to be higher activity in terms of borrowing and investment, and that can put some moderate upward pressure on interest rates, which isn't a bad thing because as the economy gets healthier and more robust, as there's more borrowing going on, there being a slightly higher cost of that borrowing isn't a big deal in the framework of a healthy, growing economy. Another factor is the supply and demand of mortgages. The money that gets invested by investors to provide funds for mortgages is coming through, in the broadest sense, one of the subcategories of the bond market. The two biggest choices that investors have to look at where they put their money is the stock market or the bond market. So if it's anticipated that the economy is going to be healthy and the stock market will then see prices go up on stocks, anyone who's looking for an investment in bonds is going to want a higher return or a higher interest rate on those bonds, which puts upward pressure on rates. Think of it this way. If people think the stock market's going to just keep chugging along, the draw of bonds that fund mortgages, and then also US Treasuries, sort of their cousin in the bond market, is safety. Those are seen as a safer investment. And if people think, well, the stock market is going to perform really highly, they're going to say, yeah, the safety of the bond market's neat, but I still need a higher return for it to be worth putting the money in there. Now, bear in mind, I am speaking in broad terms and I am kind of oversimplifying, and there are other factors that come into play, and there are complexities that I'm not either capable or have standing to speak to. But the main thing to understand is the Fed doesn't just wave a magic wand and change interest rates. A buddy of mine who's way smarter than I am put it really well. He said the bond market always has the last word. So underneath all of this, if you take nothing else away, just understand that the US economy, the global economy, doesn't just typically hang a left. So rates are going to be a dynamic thing. They're going to change based on those forward-looking estimates. The Fed has a little bit of influence over that, but at the end of the day, the markets have the final word. I hope that gives a little bit of clarity. I hope you and yours are doing well, and talk soon.